Our 2013 forecast. Now this is thoughtful. Hello, I'm Kitty Boo in Shanghai. We're bringing you our second annual forecast show this week on Thoughtful China. Globally, there's no question about it. The forecast looks bad for the rest of the world, especially in the US and Europe. The third quarter numbers at four of the largest advertising holding companies, WPP, Omnicom, Interpublic, and Publicis, all trended downwards. Let's take a closer look at a couple of examples. In late October, Ad Age reported that WPP has reduced its growth forecast as client/spending. And the Wall Street Journal, WPP CEO Martin Sorrell said, "We're extremely cautious at this point. A lot of companies are lowering guidance and missing forecasts. There is a slowdown." Over at Publicis, the story is similar. In The Guardian, CEO Maurice Levy reports worse than expected third quarter results. China has been holding steady for the past few years, but in October, the World Bank cut its forecast for China's growth rate this year, citing concerns over the weak demand for its exports and slow investment growth. As budget season comes to an end here in China, should we expect the same gloom and doom as the West? Let's find out what agencies are hearing from their clients about spending next year, where clients are looking to invest their budgets, and what trends are continuing to shape China's ad market. From the Omnicom creative agency BBDO, we have Carol Potter, President and CEO, Greater China. From Publicis Group's ZenithOptimedia, we have Mykim Chikli, Chief Operating Officer, China. From the WPP digital agency Wunderman, we have Bryce Whitwam, General Manager, China. And coming up shortly, Nick Waters, Asia Pacific CEO at Aegis Media, will share a regional perspective about how important China has become for global companies. But first, let's talk to our guest here in the studio. Carol, let's start from you. What are you hearing from your clients about spending for next year? Any percentage on increases or decreases you're hearing?
Well, I think the first thing to be said is that it's not a consistent picture across all of our clients. Actually, at BBDO, we're very lucky because we've got a good diversity of clients covering a number of different categories. And as I say, the picture does vary by category. So obviously, for example, we've got automotive clients where the growth in sales of cars has definitely slowed, but coming off a very big and probably an unsustainable growth rate. But then, we've got Mars also as a client, and the Chinese consumers seem to be consuming a lot of chocolate.
So what type of industries are more willing to spend money next year?
Well, I think most of our clients are actually investing in China because despite all the kind of naysayers and the doom and gloom that people want to talk about, the fact of the matter is that the growth rate in China is still much higher than it is anywhere else in the world. And most of our clients who are multinational big companies are investing in China. They're building factories, they're selling more in China than anywhere else in the world. And they're investing in communications too. So I have to say, and I may live to regret saying this, but I have to say that we're pretty optimistic about 2013.
Give me an idea of what's going on in the room for this year. What are the surprising findings that you've come across sitting in client meetings talking about budget?
Right. Well, I don't much care for surprises, not unless they come in a blue Tiffany box given to me by an attractive man. But talking of which, actually, I mean, that was quite a surprise. Tiffany is a client of ours, and it's very encouraging how many women out there in China in tier 2, tier 1 cities are buying or receiving expensive pieces of jewellery. In fact, almost 1 in 2 women in tier 2 cities. So I think this is an important point. I think that consumers are still feeling very optimistic and they're still spending. And actually we do our own BBDO Voices research and 65% of the people that we're talking to are believing that they'll be better off in 12 months' time. And a whacking 87% of them want to have new experiences and enjoy life.
Mykim, I know ZenithOptimedia had a recent ad spend forecast. Would you like to share some of the findings?
Sure. So first of all, I'd like to say that on a global perspective, the growth of ad spend for next year will be only 4.6%. Saying that, if we zoom to APAC region, it will be almost like 8 to 10%, and zooming to China, it might be 13 to 15%. But if we look at what happened this year, it is a decrease in terms of growth. It's still growing, but it's growing slower. Specifically in some key categories that were driving the growth, like automotive for sure, that was number one, but services, finance services will be also like slowing down a little bit. If we took luxury industry, because we are all focusing very much on luxury industry in this market, and this is where we see the biggest growth in the world, it's also slowing down right now. And I think this is slowing, I mean, in terms of growth. Overall, it's growing, right? But the growth will be maybe like 10 or 12%, where we were used to have like 20, 25 or 30% growth. So that will really make the difference.
And I agree with you that it's slowed down, but this is the critical point. It's relative. So you drop back from a 20% growth to a 12% growth. That's still a much faster growth than you're getting anywhere else in the world. And at the same time, I mean, both PPR and LVMH posted very nice profitability in September. And I think those companies will increasingly look to China.
At the same time, Burberry's results are really gloomy.
Burberry, well, but not, and this is another really key point, not every brand is a winner. I mean, I'm happy to say that the brands that we're working with in general are winners. I can't imagine why. Seriously though, I mean, you know, I'm not obviously willing to divulge their numbers, but our clients are very happy with the results that they're getting in China at the moment. But I don't disagree, there is a slowdown in the increase, but it's still a very healthy increase.
I think one thing that Mykim said is very important, and that is about efficiency. I think all the clients now, our clients at Wunderman, are talking about next year as being smarter in terms of their advertising, not necessarily, I don't want to say wildly spending like before, but certainly it's a lot different now than it used to be, and people are being more, let's say, more cautious. They're thinking about how to more optimize their channel spending, trying to think of better ways that can then deliver better return on investment. I know that's always been talked about before, but I think now it's becoming much more prevalent, especially now when there's a lot, especially in luxury categories where there's a lot more database marketing happening. There's obviously the push to digital. There's a lot more efficiencies that can be achieved, and therefore you might see a bit, of course media spend, the advertising spend is up, but it's how it's going to be used. I think that is, we're finally seeing, I think hopefully in 2013, the beginning of smart advertising in China.
So talking about smart advertising in China, which sector within the advertising spending is going to grow the fastest? How are they going to allocate their budgets then?
So you mean in terms of medium or in terms of category?
In terms of category.
In terms of category, I think luxury will still, you know, tearing up the business for sure. And automotive will slow down definitely because the sales are not what they were expecting, and this is a very tough area right now where everybody is struggling and highly competitive as well. I think cosmetics are doing pretty well. This is something that we can see, like, you know, more Chinese consumer are using skincare product, makeup product. So this is really a growing area. And overall, FMCG brands are doing pretty well. I agree. They eat more chocolate. They like chocolate, but not only chocolate. So this is what we see. Also, we did a study with the emerging middle class in China. So coming from tier 4, 3, 2, and they gonna consume a bit more. Either it's Chinese or Western brand. I think this is a new finding that we have. They don't, you know, differentiate that. And when it comes to safety, they consume more international brand, like milk, infant powder. That will be more international brand than can tear up, you know, the benefit from that. So that's very interesting to see that the consumption will really, you know, keep going.
Now, let's talk about media outlets then. So, do you think your clients will allocate more budget to traditional media such as TV or more moving towards digital?
2012, if I could say so, there was huge transformation in our clients to more digital spend. But that was like what I call digital media spend, pre-rolls and banner ads and stuff. We're basically at this stage of we're treating digital like it was a traditional medium. What we're going to see in the future is, I think, largely out of the fact that some of the channels within China, particularly Sina Weibo, and then they've launched their 2.0 platform, which ultimately creates an e-commerce platform within a social platform. So there's more monetization than let's say a Facebook that they can actually achieve. We're going to see a greater amount of efficient use of that of media within the digital space, because all our clients, including Land Rover and one of our main clients, is finding that they can get more efficient use out of the digital than traditional media, and as such, they're going to start spending there. But that's not going to be like diverting huge tracts of money. It's about efficient use of that money.
In terms of numbers, are they going to throw a lot more money into digital though?
Yeah, I think they are shifting a lot of money to digital. If I just take this year, I think at least 15% of the TV budget has already been shifted to online TV.
And indeed, I think some companies are actually mandating it now. I mean, they're actually mandating to the brand teams, you have to spend at least 10% and, more like 15, 20% of your budget on digital.
I think we need to look at the figure, the reality. They are shifting money, but we also need to look at what the consumer are doing and what the consumer are using as a medium. And if we look at that, you have some city where they totally walk away from TV and they only look at the internet version of the show, of the TV show. And also some program released on Tudo or Youku, they are accessible only on those platforms, like the Conchikailer. It's only accessible there because the TV station were not allowed to broadcast those shows. So when it comes to how I can build my mixed reach and make sure that for the same amount of money I will reach the same amount of people, then we have great opportunity either to buy national program on online TV and TV, or to buy local program. And this is very interesting because then the local TV are suffering right now because they are between the national TV, which is super powerful, and the online TV, which is super targeted. And we can really, really specifically target those people. And we have great tool right now available in this market, which is not the case in Western market.
There's a recent study that shows that over 60% of people in the evening watching television are online at the same time. I think we're going to start, and we haven't really seen that too much. In the West, we see that a lot with hashtags on popular sites. We're going to see a much more of a dual screen type of, dual type of entertainment channel that it's an awesome opportunity for brands where they can actually entertain, inform, and then draw people to e-commerce platforms and get them to talk and communicate on social media at the same time. We're going to see that start to become much more prevalent and the local TV, the stations are going to push it because they're losing ratings, as Mykim mentioned, to a lot of the alternative formats.
And actually, as a creative agency, it's fantastic for us because
awesome,
we get the opportunity to take our time with the online videos that we can use. We have the opportunity, frankly, to do things that we can't do on TV.
Well, on that note, let's take a break and hear a thought or two from Nick Waters, Asia Pacific CEO at Aegis Media, with original perspective about how important China has become for global companies.
Over the last 10 years, China's importance to multinational companies has steadily risen. With a huge population and growing disposable incomes, its attractions are obvious. The global bust from September 2008 magnified the importance. With North American and European markets in freefall, worldwide attention turned to China as an island of optimism in a sea of gloom. Marketing budgets were cut in the West and redeployed to China. With Europe bumping along the bottom and weak recovery in the US, China became the last bastion of reliable growth. But 2012 has witnessed a shift in the narrative. China's GDP growth has slowed, the housing market has cooled, and the stock market underperformed. Weak consumer demand in the West has been matched by increasing caution amongst Chinese consumers. Across industries, sales have slowed, and in some categories, consumers have been switching to less premium domestic brands. The performance of Chinese subsidiaries this year has been under the microscope in boardrooms across the Western world. With sales growth not matching budget plans and forecasts, we have seen restraint in marketing investment in a bid to maintain the bottom line. This in turn has increased pressure on the agency sector. With increased dependence on China for growth, anxiety levels about future performance have risen. With little cause for optimism in the West, the pattern for 2013 will be similar. Companies will remain fixated on China to deliver growth, but that growth will be more elusive and harder to achieve. This is the new normal that international businesses will need to adjust to. More modest rates of growth and greater challenges to achieve it.
Now let's start the second half of the discussion now with a question from actually one of our viewers, Eric Berezan. He wants to know if you are seeing rising interest in video-on-demand services provided by TV operators, despite low market reach, and when do you think video-on-demand might become big enough to interest ad agencies in China?
So right now in China, you can have all the program that you want on Youku, Tudo, Qi, or whatever. I just don't want to do the over-advertising Youku and Tudo, but they have real program, they have real stuff to watch. The online demand is a different business model, is more like a pay model, like services, and this is something that I think will be developed in China. I don't think that those providers will need us as, media professional or agency professional, because they know how to reach the consumer directly online, and they are really like the B2B2C platform, and actually they don't advertise very much because it's very tiny money when people get those programs. So I'm not sure there is a real strong business model for us, at least, but there is a business model for China. But when you look at the DVD, it costs nothing in the streets, and the use of DVD is still very huge. I'm not sure that this on-demand video is really something that will boom immediately.
So in terms of TV ad rates, am I correct to understand that maybe second tier, third tier TV stations rates are suffering tremendously, where a bigger station like powerful national TV station like CCTV, the ad rates are steady?
Yes, it's true. I'm not sure about the second tier. Second tier, specifically the coastal one, they are doing pretty well because they have, high-end, potential high-end target over there.
So Bryce, eMarketer predicts that China will be the world's second largest digital market. Do you agree with that?
Yeah, I thought it was already. Yeah, absolutely. It's going to explode because not just in terms of all the things that we just mentioned about it's of the content, of the ability, of the data opportunities, the ability to draw people into e-commerce. 10 years ago, e-commerce was just an unheard of thing here. Now it's proliferated into almost every category sector. People are so accustomed to buying things online. If you think of it in that context, your consumers will never leave the digital ecosystem from start from awareness to purchase. So as a result, if you're a smart marketer, especially, not to say that there's no role for television. There's still a lot of mass brands out there. There's a lot of people out there that probably wouldn't actually go through that type of system. But the reality is that for a good share of our customers who maybe are looking at specific targets of customers, they're pushing a lot more on digital. And yes, that will be easily the second largest by 2014.
It depends on what KPIs you base your judgments to be number one and number two. In terms of numbers of netizens, they are number one. They just have the double the size compared to the US. They are number one. In terms of penetration, is only 40%. So you see the potential of these markets is just huge. Whereas some market like US, France, or whatever, they are like 80%. So what they can do next? Nothing. The potential is there, and it's very huge. Regarding ad spend, China is the number 3 most invested market in terms of ad spend. US is number 1, Japan is number 2, China is number 3. Guess who is going to be number 2 very soon? China, of course.
Naturally.
And I'm not sure it will happen next year, because Japan hopefully is recovering as well. But for sure, 2014, that will be the battle, because China is growing very fast, and the potential is huge. We only have like maybe 1/3 of the market right now up and running.
I think so much of the noise is around digital and social media and so on. But I honestly think that we should not lose sight of the fact that TV is still a very powerful medium. If you want to tell a brand story, TV is still the best way to tell that story. It's still the way to reach a large number of people with your message, and it's still the majority of what clients spend their money on. And so, you know, whilst I think digital is absolutely critical, I think social media is very important in lots of different ways, and things like, you know, having people understand the company behind the brands, perhaps. But in truth, TV still very powerful and important medium.
TV is 40% of the investment. 40%
Ideally,
right
it's
now.
the best place to tell the story. Ideally, Carol. But I mean, most of our clients, when they go onto television, I agree with you, it is the best place to tell the story, but it's usually like for the first week, and then everything drops to a 15-second spot afterwards because of the media inflation, because of the high cost of things, because of the diversification of media. They can't, how can you tell a story in 15 seconds? No, I mean you can, but it's more and more challenging. Whereas the digital platform allows you it does provide you that opportunity to tell an enriching story over the freedom through all different types of channels. Again, the reach is still not there. You're still only, like you mentioned, Mykim, it's only 40%.
I mean, the fact is, it doesn't have to be, you know, we don't have to set it up as a combative situation. All I'm saying is, let's not, in all the noise that surrounds digital, let's not forget, let's not take our eye off the ball, that TV is still very, very powerful.
Bryce and Carol, one same question for you guys. When you talked with clients, what was their sentiment looking into 2013? Are they optimistic?
Our clients are investing in China, and they're excited about the possibilities in China. And we see that over and over. And I will tell you one interesting trend is now the number of brands that we see being managed globally from China. Now that's a really interesting shift. So we now have 3 major brands that we work with, where the person who is the, you know, everyone has different nomenclature, but the global brand franchise head, whatever, is based in China.
All our clients are building. They do not see a slowdown, but I also want to emphasize, I think one of the things that we are hearing though is that there is a careful optimism. There's a sense of cautious in terms of where things might go. It's not necessarily, especially because a large part of our client base are in the automobile sector. So one of the things that they're looking at is that, of course, now, as Carol mentioned, now a lot of these brands some of the brands are even being managed out of China, but certainly they're becoming the most important market for them. So there's huge volume targets that they have to hit. And within that pressure, there's the tendency, of course, to think that I have to hit this huge target. Oh, next year come July, we're not even there. Let's go into tactical mode and just try to sell the stuff as much as we can. We're always so in that context, one of the concerns that I'm hearing from the clients is this is still a brand building mode time in China. We don't want to go into tactical mode like so many other markets have. So how can we be cautious about that, but at the same time try to manage, you know, the brand growth in the most efficient way?
Bryce, Carol, Mykim, thank you for being on Thoughtful China today. Well, that wraps it up for today. Be sure to subscribe to us on Tudo and YouTube. You can also follow us on Weibo and Twitter. See you again.